Welcome to part 2 in my Leasing Definitions Untangled video. This is Robyn, and in this part of the video I'm going to take you through some practical application of those key definitions in IAS 17 as they apply to finance lease accounting. So as I mentioned in part 1, the focus is going to be on looking at a finance lease for a car. So hopefully you'll have a little bit of an understanding about how they work. And typically a finance lease for a car will involve a guaranteed residual. So the lessee has to make this payment at the end of the lease, and typically they can be different to the sort of ongoing, sort of like say monthly payments. They can be a larger amount. They might be 20 or 30% of that original fair value that was agreed upon at the beginning of the lease. So this is how things usually work, and that sort of then once that amount's paid, then the title, the legal ownership to that asset then passes from the lessor to the lessee. So we're going to look at the numbers involved with this. So another way to think about that is, well, a leasing company or a car dealership at the end of the lease term, they don't want to have your somewhat used car back. So that's why there tends to be a guaranteed residual. They just need you to pay the final payment so that you can get legal ownership of that car. So what we're going to do is to look at some numbers from the perspective of the lessee. So they've got their new car. They've signed this contract, the finance lease, and we're looking at recording what they have to pay. So that's going to be their lease liability, and also correspondingly that's going to be their leased asset. Because remember, we talked about the definition of a finance lease being, substantially all the risks and benefits of ownership passed to the lessee. So think about that for a car. It's your car, you have to insure it, you've got to service it, maintain it and the like. We're also going to look at some numbers from the perspective of the lessor, and again they're sort of in this to provide finance. They're wanting to make their interest, so they then need to record an asset because they've effectively made a loan to the lessee and they're having that repaid over the lease term. So let's start to have a look at some numbers. Okay, let's start looking at my spreadsheet here where I've got a finance lease, firstly with a guaranteed residual. And so I've got 3 lots of lease payments, each of $20,000 at the end of years 1, 2 and 3. And also at the end of year 3 there's a further payment, and this is for $10,000, and this is the guaranteed residual. So over the lease term there are minimum lease payments of $70,000. So I'm saying that the lessee and lessor, so the car salesman and the customer, have agreed that there was a fair value of the leased asset of $61,356. So there was lots of negotiating and they finally struck on that number. The lessor is going to incur $500 in costs in setting up the lease. So let's just think of this as a finance lease company. So they're in the business of lending money, so they've got initial direct costs. And then we need to sort of work out what the present value of the minimum lease payments are. So what I'm doing down the bottom here is just showing how that definition of the interest rate implicit in the lease actually works. Remember that equation where I had the balancing scales? We're saying, okay, the interest rate implicit in the lease is that rate that causes the present value of the minimum lease payments and any unguaranteed residual. Here the unguaranteed residual is 0. There's no unguaranteed residual, but they do have to pay the $10,000, and that's included within that present value amount of $61,856. So the present value of those amounts is equal to the sum of the fair value of the leased asset, the $61,356, and the initial direct costs incurred by this finance leasing company, let's just say it's a finance leasing company, of $500. So 61,856. So what I find is, mathematically, my implicit interest rate is 6%, because if I discount the 20, 20, 20 and 10, and I discount those using 6%, what I find is my discounted amount is 61,856, and that equals the sum of the fair value of the leased asset and those initial direct costs of the lessor. Remember here, there's no unguaranteed residual. So from the lessor's perspective, the present value is exactly the same because the minimum lease payment includes that guaranteed residual, and there's no unguaranteed residual to discount. So therefore, if I look over to my lessee's repayment schedule, it starts with a liability of 61,856, and at the end of the lease, the end of year 3, it comes down to 0. Whereas from the lessor's perspective, their receipts, their opening receivable, their loan that they're advancing to the customer is 61,856, and then over the term of that 3 years, they get interest income, and the value of that receivable, the amount that they've advanced to their leasing customer, is 0 because they make that final payment, that guaranteed residual of $10,000. Now, of course, I could have popped those two amounts together at the end of year 3. I just thought it was maybe easier for you to see the fact that that guaranteed residual is that final payment. So when there's a guaranteed residual, what the lessee and the lessor are recording as their opening values are exactly the same. So it's relatively straightforward when you've got a guaranteed residual. So that's how the definitions apply. So yes, 6% is mathematically the rate that discounts those payments, the minimum lease payments, the amount that must be paid, and brings it back to equal the fair value of the leased asset at the beginning of the lease, plus any initial direct costs incurred by that sort of leasing company. Okay, let's make a slight change to our facts, but this time with the car lease, there isn't an amount that has been committed to by the lessee. So maybe the $10,000 will be paid, maybe it's not going to be paid, but it's unguaranteed. So it's still sort of listed down here as sort of, if you like, a possible lease payment, but it's not committed to, so therefore you won't see it under the list of payments from the lessee because they haven't committed to paying that amount. What I'm going to show you now is that we're still, with these facts, arriving at an implicit interest rate of 6%, so that's unchanged. Also unchanged is the fair value of the leased asset at the beginning, 61,356. Those initial direct costs incurred by the finance leasing company. But so what we see then is where the difference lies in the present value of these amounts for the lessor is this time different to the present value of the minimum lease payments that the lessee has agreed to make. And that's because of the fact that the lessee isn't committed to paying that. So our interest rate implicit in the lease, that definition says it's the rate that causes the present value of the minimum lease payments, what the lessee is committing to pay, and the present value of the unguaranteed residual, which is 8,396, to be equal to the sum of the fair value of the leased asset at the beginning of the lease and those initial direct costs that the lessor is going to incur. So what we find is, we still get 6%. So we've got this, it's still in the lessor's column, it's discounted, and so we find that, we've still got 6%. That rate doesn't change, even though it's an unguaranteed residual, so 61,856. What you see is the difference then is over in my repayment schedules. So from the lessee's perspective, the liability that they're going to recognise when they first get into the lease is the 53,460, whereas on the previous screen we were showing the 61,856 as their liability, but they're not liable for that final amount. They're not committed to it, so their liability is only the 53,460. Their minimum lease payments in present value terms, what must they pay over the 3 years, is 53,460. So your lease payment schedule, interest, liability reductions for those 3 lots of 20 grand, your closing liability at the end of the year 3 is 0. From the lessor's perspective, their receivable is this sort of present value amount, which includes the present value of that unguaranteed residual. And then what you see is over the 3 years, they receive those $20,000 from the lessee. So at the end of the lease term, they've got a receivable worth $10,000. And that's because at that time, maybe the lessee will say, oh, okay, I will pay that amount and take legal ownership of the asset. But otherwise they might say to the lessor, here, have your used asset back. If that was the case, then the lessor would be taking this amount out of their sort of receivable account and transferring it into their fixed assets, because they'd be getting their used asset back, which notionally will have a value of $10,000 at the end of year 3. So that's why when you have an unguaranteed residual, the values that are recorded at the beginning of the lease are different for the lessor compared with the lessee. And it's all because of the present value of that unguaranteed residual amount. So the implicit interest rate doesn't alter. What alters is the liability that the lessee records, because they're only recording what they're committed to. So that brings me to the end of our Leasing Definitions Untangled video. I hope that this has helped you to see how these different definitions apply in practice. So thank you for listening, and remember, if you have any queries, please post them onto the discussion forum. Cheers.